I don't know. I mean, the inflation expectations are fairly muted. The Fed cited global growth, which is slowing. Michael Zinn also cited tighter financial conditions. And yes, it's been a strong run in January, but now we're just closing at levels that take us back to December 3rd for the Dow and the S&P.
That's right. Yeah, I mean, I think you can feel the market trying to understand how to regard the Fed. At this point in December, it was sort of like, we're going to let you cry it out. And then obviously Powell got much more dovish, much more policy driven and sensitive. But now we're going from, well, maybe they're going to cut, to the jobs report was pretty strong, the ISM was pretty strong, pretty big bounce actually in inflation expectations now, pretty big bounce in oil. So is the Fed going to start hiking rates? Are they going to hike once or twice? I don't think the market knows, and I think that's why the strong macro numbers today gave the market a little congestion.
Can they change their mind, Michael, as quickly as next meeting? Or would they have to now, no matter how strong the data is, at least wait a little bit longer given the about-face turn that we've seen in the last few months?
I don't think change their minds in terms of hiking in March. I think that's highly unlikely. And I think that, folks are thinking about June or September rather, if it's going to happen. But you certainly could see messaging begin to change. I think that's what the market is trying to figure here. Are we going to get higher rates in 2019? I think we just don't know yet.
I mean, I think the thing to keep in mind is nothing substantive has actually changed. Words have changed, messages have changed, but they hiked when they were supposed to in December. Nobody expected them to do anything in January. You mentioned financial conditions, Sarah. Nothing from the Fed hike in December to now is tighter in terms of financial conditions. It's all looser. Dollars down, VIX is down, stocks are up, credit spreads are compressed.
But they got spooked.
They got tighter from where they were in October and November. But between then and now, yes, they got spooked.
So they were
and
late.
They want to reinforce the idea, look, we're not going to try and get ahead of this and restrain the economy unduly.
So if you are long U.S. stocks, certainly you could thank the Fed for this week. But how about emerging markets? They did even better than U.S. stocks on the week. My chart of the week is actually EEM, which is the ETF here that tracks emerging markets, and had a very strong week. Everybody loves emerging markets right now. I can't tell you the number of strategists that come on and say, look, the Fed's taking a breather, buy emerging markets, the dollar's weak. That helps, Michael. Is that becoming a crowded bet?
I wouldn't say it's crowded. You've had the valuation argument there for a long time. I think what you probably need to see is dollar weakness. You did see the dollar begin to flirt with its 200-day on the downside, but I think it does go back to the Fed, because if you don't really get weak dollar, you don't normally see emerging markets really outperforming in a way that's super helpful. So I think that's still going to be an open question.
A weak dollar, rising risk appetites, and also weak dollar, if that really allows China to fully, go guns blazing with stimulus, right, without risk of the worst currency effects there. I do think that makes a lot of sense.
I just think it's interesting that the Fed pause is felt all over the world.
Well, it certainly is, but actually, I would say kind of equally interesting if you look at January, where we saw markets, of course, take off significantly. The US absolutely led the charge there. Yes, you saw decent returns globally, but in Europe it was more like mid-single digits, and in Asia it was less than that, apart from China that was good. And to that point, yes, we saw a soft dollar for the course of year to date, but it's only down 0.6%.
Right.
And again, China was the best performing of the EMs for the month of January, and we did see a big move in the Chinese yuan. So again, the dollar's clearly important, but for the year-to-date performance, it hasn't moved that much, and that's why the US has outperformed.
Of course, in the latter part of December, when the U.S. had that final spike lower, the emerging markets and Chinese stocks did outperform. In other words, it didn't go down as much. So it's almost as if the emerging markets kind of led the way down in the global markets and perhaps bottomed a little bit earlier.
So which do you want to have, Michael, right now? Do you want to have a domestic mindset and get into Russell 2000 on concerns about slowdown in places like Europe, or you want to go abroad where the valuations look better, and with the Fed on hold, there's some breathing room?
I would stay mostly U.S. because I think that we have seen the Fed say we will help you if you get in a rough patch. I think that's now clear. But I think we're close enough to the end of the cycle that not being too cyclical in positioning, I think, makes sense. And since the U.S. is a predominantly consumer-driven, less cyclical-driven market than nearly almost any other market that you can find, I'd still place the bets on the safer bet in the U.S.
Let's talk about Amazon falling today despite reporting a beat on the top and bottom line yesterday after the close, after issuing lighter full-year guidance than expected, and after the CFO warned Amazon will see an increase in investment compared to 2018. And Mike, I guess this all comes back to what it does to the margin, the bottom line, and where the valuation is, therefore, for a relatively, well, a very mature company, growing fast but mature.
Exactly, and to some degree, the premise of investors who had rushed back into Amazon from the lows. I mean, there was one storyline which said, okay, Amazon is finally in kind of harvesting mode. They have shown rising and outperforming profits on the bottom line a couple of quarters in a row. This changes the story. I mean, it's nothing really new from the long-term perspective with Amazon. They do go through these heavy investment cycles. The company probably thinks it's doing nothing different. But yes, from a mature company, but it's still growing fast, but not as fast. I think it was a little, to me, a 5% move down is really not a big deal, considering how much it had ramped off the lows.
I know you don't talk individual stocks,
Yeah.
but it sort of gets into whether you want to be in growth or you want to be in value, if
Yeah.
you want to be in this market right now.
Yeah. And I'll just say generally, one thing that I think did stand out, that'll be a question for some of the reporters next week, was the advertising sector of that. I think that's something that people are going to want to look at, and whether that's a read-through or whether that's just something that other online advertisers are still being able to sort
we
of
got
protect
Alphabet
For
on
them,
Monday,
they were up
so-
100% or nearly 95% year over year, so it's not really.
But that was a moderation,
Exactly.
I guess, in growth.
Yeah.
But
yeah.
it's more of a structural threat, I guess, to some of the others' names, if Amazon's
That's
really
the question
moving into.
to be answered.
So
yeah.
do you want to be in the stocks that led the market for the
Yeah.
last few years, like an Amazon, or more shift to value?
Yeah, I personally still think I would stay with more of the growth because I do think we're sort of late cycle. Having said that, I do think in some of the industrial prints we saw this week, I think you saw some really nice stuff. You saw some real good return on investment in some of the big integrated industrials who have great products. The cycle has lasted long enough that they can really get some really good return on those investments because we've gotten a couple of extra years more so than people thought.